Valuation. Jersey Mike's hasn't set terms, but the reporting has the IPO landing between 10 and 12 billion. And Blackstone, remember, paid around 8 billion for the whole thing in early 2025 with a lot of debt. So restaurant franchises get valued on a multiple of EBITDA. Jersey Mike's did 339 million of adjusted EBITDA in 2025. If you stack the 12 billion equity target on the 1.9 billion of net debt, you're paying about 13.9 billion for the enterprise, which pencils out to 41x trailing EBITDA. On next year's estimate, it's around 35x. So here's where the comps sit today. Domino's, the best performing stock of the last 20 years, if you're comparing it to tech companies, 18x EBITDA. It's mature. It is the franchise gold standard and has the same securitized debt structure that Jersey Mike's uses. So that does make it a good comp. Wingstop, this is where the CEO came from. 23 to 25x EBITDA. It's the fastest grower of the last decade in Charlie Morrison's old shop. Worth noting that that number is down hard because Wingstop's US same-store sales went negative this year and the stock is off about 65% from its peak, but boy, is it delicious. Older franchise buyouts. Slower brands like Denny's, Del Taco, I've never heard of Del Taco, Bojangles, that's fun, 8 to 11x EBITDA. So they're asking 41x trailing for a business growing same-store sales in the low single digits against a peer set where the best growth story in the group trades at 25x. Well, its comp shrink. So how do you get there? Well, to underwrite 12 billion, you have to believe two things happen. Unit growth stays high, and the international bet in Canada and UK exceeds US level economics. Early call here, but Canada's first few stores are running above the domestic AUV, which is a start, but hey, it's a small base. So Blackstone's 8 billion from 18 months ago is probably the floor, right? My read is the business supports something closer to 9 to 10 billion on the current comps, and 12 billion is going to ask investors to pay up front for the international growth before it ever shows up in the numbers. So here's some miscellaneous stuff of note. It's pretty funny. They're scared of quantum computing coming for the turkey. The risk factors run the standard AI hedge where you just have to throw it in, I guess. Their tools could be incorrectly designed. It could leak their IP, could invite lawsuits. Then it keeps going and warns that their systems could someday be undone by quantum computing. This is a company that makes subs by hand to order in front of you. So somewhere in the drafting, a lawyer walked in the room and made them hedge against a quantum attack on the provolone. Hide the cheese. There's a hidden 53rd week of the calendar. I'm such a nerd for this. So Jersey Mike's runs a 52 or 53 week fiscal year, and every few years, a 14th week of a quarter will get bolted onto Q4. So most quarters have 13 weeks. The year it happens, the company picks up an extra week of sales the prior year didn't have, and the annual comp looks stronger for reasons that have nothing to do with more people buying subs. I love seasonality quirks because their fiscal year is no longer just only ending on a December 31st. It ends on the final Sunday. No drive-through is a feature, not a bug. A Jersey Mike's costs a lot less to build, that 500 grand or so, partly because they skip the drive-through lane that Chick-fil-A or Wendy's pays for. This means that real estate is more available, it's cheaper build out, and a faster path to a franchisee's return. So what's the verdict here? It's a great business, and the subs are delicious. The royalty machine is legit, the operator's clear return worth re-upping, and the store-level margins are the kind you rarely see attached to actual food. The question isn't whether Jersey Mike's is good, it's whether 12 billion is the right price to buy it from Blackstone after Blackstone already piled the debt onto it, pulled its dividends, and kept the votes. So buy the sandwich every Friday, read the fine print twice before you buy the stock. None of this is investment advice. I wrote most of it on my kitchen table while my dog sat at my feet waiting for the scraps of the Italian sandwich that I got from Jersey Mike's today. Do your own homework. Wishing you the giant, extra vinegar, and an entry price that leaves something on the table for the rest of us. Peace. Everyone in finance is adopting AI right now. There's a problem because there are a dozen disconnected tools. You got one for revenue, one for AP, one for close, and each one of these needs training and documentation. And the expertise to run them lives in your team's heads, not your systems. Maximore takes the opposite approach. One autonomous finance platform for the whole operation. Order to cash, procure to pay, the close, cash management, reporting, running on a single unified finance context that pulls from your ERP, billing, banks, even email and Slack. Maximore runs on self-learning agents that learn how your team already works. No prompts to write, no workflows to build, nothing to document. Every output is audit ready, and when a call needs human judgment, it escalates for review. Because the agents optimize, not just execute. And your KPIs improve. I'm talking about DSO, working capital, cash conversion. In fact, one PE-backed customer cut their close in half. Their audit findings from 7 to 0, back office costs down 70%. And in 6 months, no ERP rip and replace. You pay only for real outcomes, not seats. See it at maximore.ai. That is maximor.ai.